Disclaimer.
It is January 15th, 2026, and what we've been tracking has just hit the point of no return. Yesterday, January 14th, silver officially shattered the $92 mark for the first time in history, while gold is holding its ground in a massive assault above $4,630. But forget the trading charts for a second. The real explosion just happened behind the scenes. The US Mint has just officially announced they are suspending sales of silver numismatic products. Why? Because at current prices, they simply cannot guarantee supply without losing money compared to the actual physical market. Meanwhile, in your comments, it's absolute chaos. Dozens of you are reporting that orders placed at $80 are being held for restock, while in Shanghai, physical buyers are already paying massive premiums that the COMEX can no longer hide. Like we often say, we are in the early innings of a game where the stadium is already on fire. Today, we are breaking down the absolute urgency. First, the Shanghai vacuum, how the East is physically draining Western vaults while we stare at outdated paper prices. Second, the US Mint Alert, why the government halting sales is the final signal that fiat currency has lost the war against real metal. And third, the short-term wall, with 948 million ounces traded in a single day, more than the entire world's annual production. How long before the banks officially declare force majeure? Hold on to your bars. Don't let the volatility shake you out. We're getting started right now. Picture this. You walk into your local coin shop next Tuesday morning, cash in hand, ready to buy a couple of silver eagles at that $90 spot price you saw online. The dealer looks at you with something between sympathy and disbelief. "I can sell you what I have," he says slowly, "but it's going to cost you $105 per ounce, and I have no idea when I can get more." You pull out your phone, refresh the COMEX price, still shows $90. What you're witnessing isn't a greedy dealer marking up inventory. You're watching the real price of silver announce itself while 99% of the population still believes the ghost price flickering on their screens. Here's what should grab our attention. Right now, physical silver bars are trading for $15 more per ounce in Shanghai than in New York. $15. That's not arbitrage that disappears in minutes. This premium has been widening for months, and it represents something our financial system has never openly admitted. The East is vacuuming physical metal out of Western vaults at a pace that makes 2008 look like a dress rehearsal. According to data from the Shanghai Gold Exchange, Chinese buyers are paying significantly above Western spot prices to secure actual delivery of metal, not paper promises. When you see a $15 gap that persists day after day, you're watching trust drain out of the system in real time. The paper price says one thing. The price of metal you can actually touch says something completely different. But here's where the story takes a darker turn. In late 2024, governments and central banks quietly reclassified silver from an industrial commodity to a strategic resource. You know what happens when something becomes strategic? The cheap supply disappears overnight. We saw this with lithium and rare earth elements. Now we're seeing it with silver. The Bank for International Settlements reports that central banks have shifted to full repatriation mode, pulling their physical reserves back from vaults in London and New York into domestic storage. What does that mean for us? The counterparty trust that held the paper COMEX system together for decades is dissolving. When central banks trusted each other enough to store metal in shared facilities and settle with paper contracts, the system could handle enormous leverage, hundreds of paper claims on every physical ounce. That trust is evaporating. Countries want their metal home, in their vaults, under their control. And when that trust disappears, the leverage that kept silver prices artificially low starts to collapse like a house of cards in a windstorm. Have you noticed how the mainstream media barely mentions this breakout above $90? CNBC runs endless segments about tech stocks, but the biggest move in precious metals in over a decade gets 30 seconds buried in the commodities section. That silence should tell you something. When nobody is talking about an asset except a small group quietly loading their cars with monster boxes, you might be sitting on the opportunity of a lifetime. We are currently in what market historians will later call the early innings of a global scramble. The $90 breakout isn't happening because Western investors suddenly woke up. This price is being dragged higher by physical demand in the East, kicking and screaming against Western paper forces, desperately trying to suppress it. Think about that dynamic. The price is going up despite the system fighting against it. What happens when the system can't fight anymore because there's nothing left in the vault to deliver? Pop quiz. What do you call a market where the paper price and physical price separate by double digits and stay separated? A market in the process of breaking. This is what economists call the Great Divorce, the point where paper derivatives and physical reality can no longer maintain the illusion of unity. We watched a version of this in 2020 when gold briefly traded at $100 premiums. But that was temporary, driven by logistics. This time, the shortage is driven by central banks, industrial users, and Eastern governments all competing for the same finite supply while the West keeps printing more paper contracts. This $90 level represents a point of no return because miners who struggled at $20 silver are now printing money, but ramping up new production takes 3 to 5 years minimum. According to the Silver Institute, global mine production has been flat for a decade, while industrial demand climbed steadily. Solar panels, electric vehicles, AI chips, 5G infrastructure, all depend on silver without ready substitutes. And all are expanding exponentially right when available. Supply is becoming scarce. Think about your own retirement strategy. You keep hearing whispers about inflation, currency instability, de-dollarization. You decide to put 5 or 10% into physical precious metals as insurance. You go online, start researching dealers, and increasingly you're finding out of stock, massive premiums, or suspicious shipping delays. The metal that was supposed to be boring insurance is suddenly acting like a hot concert ticket. Available in theory, elusive in practice. Bullion dealer networks across the country report inventory turnover rates accelerating dramatically in early 2026. Dealers are seeing something rare, customers buying in quantity without negotiating, paying premiums without complaint, coming back days later asking if more inventory arrived. That behavior happens when people understand something is changing and need to position before everyone else figures it out. The life raft is still accessible, but filling up fast. Every day, more people wake up to the reality that silver under $100 per ounce might be one of those moments future generations study in textbooks. The brief window when a strategic metal traded below its industrial replacement value while the global monetary system restructured. Most Americans are still watching Netflix, completely unaware that the financial ground is shifting beneath our feet. This isn't fear-mongering. This is pattern recognition. We've seen this with other commodities when paper price and physical reality diverged until the paper price gave up and snapped to match reality. The difference is that silver sits at the intersection of monetary history, industrial necessity, and geopolitical power struggles. When you combine those three forces, you don't get a gradual adjustment. You get a repricing event that leaves people asking how they missed something so obvious in hindsight. The $90 breakout is a warning shot. The $15 Shanghai premium is a billboard. And the empty shelves at your local coin shop will be the confirmation. But by the time most people see the confirmation, the opportunity to buy physical silver at these prices will have closed like a door slamming shut in a windstorm. The system is showing cracks, the smart money is moving, and the clock is ticking. Quick reminder, if this content is helping you understand what's really happening in these markets, smash that like button and subscribe to stay ahead of the curve. Now let's talk about the numbers that should terrify every major bank on Wall Street. On a single trading day in January 2026, the paper silver market traded 948 million ounces. Let that sink in for a moment. In one day, traders exchanged contracts representing nearly 1 billion ounces of silver. According to the Silver Institute, total global mine production for an entire year is roughly 760 million ounces. We just watched the paper market trade 25% more silver in 8 hours than every mine on planet Earth will dig out of the ground in 12 months. You want to talk about mathematical impossibilities? This is the definition. When a market can conjure more supply on paper in a single session than physically exists in annual production, you're not looking at price discovery. You're looking at price suppression through leverage, so extreme it borders on financial fiction. And the banks know it. Bank of America and Citigroup are sitting on a combined short position estimated at 4.4 billion ounces. And that's not a typo. Billion with a B. That's roughly 6 years of total global production sold short on paper, betting that prices would stay low forever. But here's where their bet is falling apart in real time. The physical market doesn't care about paper contracts when industrial users show up demanding actual metal. And right now, we're witnessing what analysts are calling the Olitios solar cliff. The moment when renewable energy manufacturers and AI chip producers are outbidding retail investors for raw silver before it even gets refined into bars. Companies building solar panels can't wait 3 months for delivery. They need silver this week, next week, every week, or their production lines shut down. When you're manufacturing components worth thousands of dollars, paying an extra $15 per ounce for guaranteed supply is just the cost of doing business. Think about what this means for the average investor trying to buy a few Eagles or Maples. You're competing against industries with billion-dollar budgets and razor-thin delivery deadlines. They're not looking at silver as an investment. They're looking at it as a critical input they cannot substitute. You can't build a solar panel without silver. You can't manufacture high-performance semiconductors without it. There's no magical alternative, sitting in a lab somewhere ready to replace silver's unique electrical and thermal conductivity properties. Industrial demand isn't optional, and it isn't flexible. According to commodity research firms, we've hit a structural deficit that paper contracts can no longer hide. For years, the shortfall between mine supply and industrial demand was filled by recycling, government stockpile sales, and investor selling during price drops. All three of those cushions are disappearing simultaneously. Recycling rates have plateaued because modern electronics use such tiny amounts of silver that recovery costs often exceed the metal as value. Government stockpiles have been drawn down to strategic minimums. And investors? They're not selling. They're buying and holding, watching the Shanghai premium and understanding that something fundamental has shifted. Now, let's talk about the companies actually digging this metal out of the ground. Silver mining stocks are behaving like a coiled spring right now, and most investors have no idea what's about to release. When silver was trading at $28 per ounce, miners were barely profitable. Many were operating at losses, kept alive by loans in the hope of better prices. At $90 silver, these same companies are printing money. Their cost structures haven't changed dramatically. Labor, equipment, energy remain relatively stable, but their revenue per ounce has more than quadrupled. What should grab your attention is this. Despite massive profit margin expansion, most silver mining stocks are still trading near their historical averages, as if silver were still at $25. The market hasn't priced in the reality that these companies are about to report earnings that will shock analysts who built models assuming silver would never break 35. We're talking about companies that could see profit margins expand by 300% or more in a single quarter. When those numbers hit, when the mainstream financial press is forced to cover it, the revaluation of mining equities could be violent and swift. This is the slingshot effect investors who understand commodity cycles watch for. The metal moves first, driven by physical demand and supply constraints. Then, with a lag of weeks or months, the companies producing that metal get revalued as investors realize the profit implications. We're in that lag period right now. Silver has made its move. The mining stocks haven't caught up yet, but they will. They always do. The question is whether you position yourself before or after the general public figures it out. But let's get back to the immediate crisis facing the physical market. On January 12th, multiple bullion dealers issued what can only be described as force majeure warnings to their customers. Now, force majeure is legal language that essentially means we can't fulfill our obligations due to circumstances beyond our control. When dealers start using that terminology, you know the situation is desperate. What they're facing is a replacement cost crisis that threatens their entire business model. Here's how it works. A dealer sells you an ounce of silver today at $92, which represents the current market price plus their normal markup. That sounds straightforward until you realize that to stay in business, they need to replace that ounce in their inventory. But when they try to buy replacement metal from wholesalers or refineries, they're being quoted prices significantly higher than what they just sold to you, or worse, being told there's no available supply at any price, with delivery timelines stretching into weeks or months. Think about the business implications. Every sale potentially loses them money if replacement costs keep rising. Every ounce they sell today might cost them $10 or $20 more to replace tomorrow. This isn't sustainable. This is how dealers go bankrupt or simply stop selling, which is exactly what we're seeing with the U.S. Mint suspension and independent dealers putting up out-of-stock notices across their websites. You know what's even more revealing? The metals aren't gone. They exist. They're sitting in vaults somewhere, but they're not moving. Holders aren't selling at current prices because they believe prices are going higher. Refineries are prioritizing industrial contracts over retail investors. Mints are rationing supply. The entire distribution chain is seizing up, not because of a shortage in absolute terms, but because of a shortage of people willing to part with physical metal. At prices, the paper market claims are accurate. This is the replacement cost death spiral in action. As long as prices are rising and supply is constrained, every seller faces the same calculation. Why would I sell today when I might get significantly more tomorrow? Why would I exchange my physical metal for dollars that are losing purchasing power when I could hold the metal and watch it appreciate? This psychology feeds on itself, creating the exact shortage it fears, turning a tight market into a frozen market. We've seen this pattern before in other commodities during supply crunches. But silver is unique because it operates in two worlds simultaneously: the industrial world that needs it for manufacturing and the monetary world that wants it for wealth preservation. When both worlds are competing for the same finite supply and the paper market is still pretending there's unlimited availability, something has to break. And that something is usually the paper price snapping upward to match physical reality, often in moves that happen over days or even hours, not months. The evidence is everywhere if you're willing to look. The Shanghai premium that won't narrow, the mining stocks that haven't priced in the new reality, the dealer warnings about replacement costs, the bank short positions that represent years of global production, the industrial demand cliff that can't be satisfied with paper promises. Each data point individually might be explainable, Together, they paint a picture of a market approaching a breaking point where the fiction of unlimited paper supply collides with the reality of constrained physical availability. This isn't speculation, this is documentation. The numbers are public, the trends are clear, the warnings have been issued. What happens next depends on how quickly the broader market wakes up to what a small group of informed investors already understand. We're watching a monetary metal reprice itself in real time, and the window to participate at current levels is measured in weeks, not years. Have you ever wondered what happens when one of the world's most powerful mints suddenly stops selling one of its most popular products? Well, we don't have to wonder anymore because it's happening right now. The U.S. Mint has suspended sales of its 2224 Morgan & Peace silver dollars. Officially, they're citing website issues and an overwhelming number of orders. But let's be real, does that sound like the whole story? This isn't just a technical glitch, it's a massive red flag waving right in front of us, signaling a potential silver crisis that could be just around the corner. Today, we're diving deep into what's really going on. We'll connect the dots between the U.S. Mint's surprising move, what the market is telling us, and what history teaches us about moments like these. This isn't about fear, it's about being informed. So stick around, because what you're about to hear is something the mainstream financial news isn't talking about yet. First, let's break down the U.S. Mint's announcement. They claimed their website couldn't handle the traffic for the pre-order of the 2024 Morgan & Peace silver dollars. Think about that for a second. We're in an age of incredible digital infrastructure. Major retailers handle millions of transactions during Black Friday sales without a hitch. Is it really believable that the U.S. Mint, an institution with immense resources, was caught so off guard by demand for a highly anticipated product? It seems unlikely. A more plausible explanation is that they simply don't have the physical silver to meet the demand. This points to a severe shortage in the physical silver market. The demand isn't just from collectors, it's from everyday people and investors who are waking up to the importance of holding tangible assets. They're looking for a safe haven from inflation and economic uncertainty, and silver has been a trusted store of value for thousands of years. The Mint OS excuse of a website crash feels more like a convenient cover story to mask a much deeper problem, a supply crunch. Now, let's look at the broader market. When you check the spot price of silver on your favorite financial app, you're seeing the price of paper silver. This is the world of futures contracts, ETFs, and other derivatives. It's a massive market, but it's largely disconnected from the physical metal itself. For every 1 ounce of physical silver that actually exists and is available for delivery, there are hundreds, maybe even thousands, of paper claims on that same ounce. This creates a huge illusion. The paper market can keep prices artificially suppressed because traders can create and sell contracts out of thin air. But what happens when people start demanding physical delivery? The system breaks. This is the disconnect we're seeing right now. While the paper price might be hovering around a certain level, the price you actually pay for a physical silver coin or bar is much higher. This difference is called the premium, and it's been widening significantly. When the U.S. Mint, a major supplier of physical silver coins, effectively says, "We can't sell you anymore," it sends a shockwave through the physical market. It tells you that the supply is incredibly tight. Other dealers will have to pick up the slack, but they face the same supply issues. This pushes premiums even higher and makes it harder for the average person to get their hands on physical silver. We're witnessing a classic supply and demand squeeze, but on a global scale. The paper market can pretend everything is fine for a while, but reality always catches up. The reality is that there's a run on physical silver, and the official suppliers are struggling to keep up. This isn't the first time we've seen something like this. History is filled with examples of governments mismanaging their currency and citizens turning to gold and silver to protect their wealth. Let's go back to the Roman Empire. The denarius, their silver coin, was originally almost pure silver. But over centuries, as emperors spent lavishly on wars and luxuries, they started debasing the currency. They mixed in cheaper metals like copper, reducing the silver content to stretch their finances. At first, people didn't notice. A denarius was a denarius, but soon they realized the new coins felt lighter and looked different. They started hoarding the old, pure silver coins and spending the new, debased ones. This is Gresham's law. Bad money drives out good. The value of the currency plummeted, leading to hyperinflation and contributing to the eventual collapse of the Western Roman Empire. The citizens who held onto real silver and gold were the ones who preserved their wealth through the chaos. Fast forward to the 1960s in the United States. The U.S. was on a silver standard, and our coins, dimes, quarters, and half dollars, were made of 90% silver. But as the government printed more and more money to fund the Vietnam War and social programs, the price of silver started to rise. It became profitable to melt down the coins for their silver content. People started hoarding silver coins. The government saw this coming and, in 1965, removed silver from dimes and quarters, replacing it with copper and nickel. They tried to keep the silver in the half dollar for a few more years, but eventually that was gone too. In both of these historical cases, there was a disconnect between the face value of the money and the intrinsic value of the metal it was made from. And in both cases, the government couldn't stop the physical metal from disappearing from circulation as people sought to protect their purchasing power. What we're seeing now with the US Mint is a modern version of the same story. The paper price is the government-endorsed face value, but the frantic demand and supply shortages in the physical market show that people are losing faith in the paper system. So, what does this all mean for you? The widening gap between the paper price and the physical price of silver is the key indicator to watch. When it becomes impossible to ignore, the paper market will be forced to reckon with the physical reality. This could lead to a massive repricing of silver, where the spot price violently catches up to where the physical market already is. Think of it like a game of musical chairs. There are 100 players dancing around, but only one chair. As long as the music is playing, everything seems fine. But when the music stops, 99 people are left with nothing. The paper, silver contracts are the dancers, and the physical silver is the one chair. The US Mint halting sales is like the DJ slowing down the music, warning everyone that the game is about to end. This isn't just about silver, it's a symptom of a much larger issue in our financial system. For decades, we have moved further and further away from sound money and deeper into a system built on debt and derivatives. The actions of the US Mint are a clear signal that this system is under immense strain. The demand for real, tangible assets is a vote of no confidence in the future of fiat currencies. This situation isn't a prediction of doom, but a call to be aware and prepared. Understanding the difference between paper and physical markets is crucial. Watching the premiums on physical metals gives you a truer sense of the market than the spot price alone. History shows us that during times of economic uncertainty and currency debasement, physical gold and silver have been reliable protectors of wealth. The story of the 2024 Morgan and Peace dollars isn't just a niche collector's issue. It's a canary in the coal mine for the global financial system. It's a powerful reminder that when push comes to shove, the only thing that matters is what you can hold in your hand. The disconnect is growing, the supply is tightening, and history is knocking on our door. The question is, are we listening? Thank you for joining me on this deep dive today. If you found this information valuable and want to stay ahead of the curve on what's really happening in the economy and precious metals markets, make sure to subscribe to the channel and hit that notification bell. It helps us continue to bring you this kind of in-depth analysis. Stay smart, stay informed, and I'll see you in the next video.